You found smart money concepts, and for a while, it felt like you finally understood the market. Order blocks, fair value gaps, break-off structure, liquidity sweep, premium and discount. You studied it, you drew it, you waited for the setup, and then it stopped working. Or maybe it never fully worked. Maybe you had winning trades, but you could never explain exactly why some worked and others failed at identical levels. So you studied more, and more confluences drew more zones, watched more videos, and the result stayed the same. This is not a learning problem. This is a definition problem. Because what most traders thinks SMC is and what SMC actually is are two completely different things. By the end of this video, you will understand why most traders who study SMC never become consistently profitable with it. Not because the concepts are wrong, not because they did not study hard enough, but because they were handed a translation and told it was the original language. What I am going to show you today is the original language, and once you hear it, the translation will never be enough again. Stay with me. This channel does not teach SMC as a pattern system. It teaches the logic that SMC patterns are a symptom of. There is a difference, and that difference is the reason two traders can study identical concepts, look at identical charts, and arrive at completely different levels of understanding. One sees structure, the other sees behavior. One read the chart, the other read the market. This video is about making that shift, not gradually today. But you are about to hear is not a summary of what is already circulating on YouTube about smart money concepts. It is what thousands of hours of direct market study produced when I stopped accepting the translation and went looking for the original language. Most SMC content teaches patterns, labels, entry systems, but on visual recognition. What this channel teaches is the institutional logic. Those patterns are the symptoms of. The distinction matters, and it took a significant amount of time, and it took a significant amount of time and a significant number of failed trades to understand exactly why. Here is how almost every trader first encounters smart money concept. They are shown a chart, they are shown zones, they are told that institutions leave footprints. And if you learn to read those footprints, you can trade alongside smart money instead of against it. And that forming is not wrong, it is incomplete, because the first thing most traders do with SMC is turn it into a visual system. Order blocks become entry zone, fair value gaps becomes price magnets, break of structure becomes trend confirmation, liquidity becomes just the highs and lows on a chart. Everything becomes something to draw, something to mark, something to wait for price to return. And for a while, this works. Partially, occasionally, enough to feel like progress. Then the traders start noticing something uncomfortable. Price returns to the order block and continues through it. The fair value gap fills, but price does not reverse. The break of structure forms, but the move never develops. The liquidity sweep happens, but the entry fails anyway. And the trader's first response is to look for what they drew incorrectly. A better order block, a cleaner fair value gap, a more precise liquidity level, more drawings, more confluences, more precision on the same system, producing the same results. Here is the behavioral reality of that movement. The trader is sitting at the screen, at the chart, convinced the answer is in the drawing, convinced that if they can just find the right zone, the market will finally respond the way it should. That conviction, that certainty, that the pattern is the answer, is exactly what keeps the result the same, because the market was never reacting to the drawings. It was reacting to something the drawings were only pointed toward. There was a specific period where my charts looked like architecture. Every order block marked, every fair value gap shaped, every liquidity level noted, premium and discount drawn on every time frame. The analysis was thorough. The zones were technically correct, and I kept losing. Not randomly. On technically correct setups, price would return to the order block, react, give me the entry signal, and then continue through the zone as if it was not there. My response was to refine. Better order blocks, more precise entries, tighter confluence stake, more drawings, more precision, more rules applied to the same system, producing the same results. So I went deeper, studied more, added more conditions, found traders with more confluences, more filters, more layers stacked on top of what was already failing. The answer had to be in there somewhere. It was not. Then one night, after a technically perfect setup failed in the cleanest possible way, I stopped adding conditions and I asked a different question. Not what did I draw incorrectly, but what was the market actually doing when it arrived at my zone? And when I looked at the chart through that question, I saw something I had never seen before. The zone were not failing because they were drawn incorrectly. They were failing because I was treating the pattern as the cause, when it was only the evidence of something that had already happened. The order block was not a signal, it was a footprint, and I had been entering footprints without understanding what created them, or whether the condition that created them had any relevance to what was about to happen next. That was not a drawing problem, that was a definition problem, and that distinction between patterns and cause and pattern as symptoms is exactly what most SMC traders never find. Here is the belief that sits underneath every failed SMC trade, that SMC is a pattern recognition system. It is not. Pattern recognition is what retail traders do with SMC. Liquidity execution is what SMC actually describes. Those are not the same things. A pattern recognition system says when price returns to this zone, something will happen. A liquidity execution model says price is being moved to this location because something specific needs to be collected there before the real move can begin. One is reactive, the other is casual. Retail trader asks where is the order block? Operator asks where is the liquidity sitting right now? Who is positioned incorrectly? What would price need to do to unlock the orders resting at that level? The drawings on the chart are not the answer, they are the evidence of a question the market already answered before you opened the chart. In a moment, I am going to show you exactly what SMC becomes once you stop seeing it as a mapping system and start seeing it as a behavioral model. But first, I need to show you this shift that changes everything, because this is not about learning new concepts. It is about understanding the ones you already know at a completely different level. Smart money concepts is not a trading strategy. It is a framework for understanding how large participants, institutions, banks, funds are forced to behave when they move significant capital through a market. Forced, that word matters, and institutions managing hundreds of millions cannot enter the way a retail trader enters. A market order of that size creates slippage. It moves price against the position before it is even filled. So institutions do not chase price, they engineer the condition for price to come to them, and those conditions always involve one thing: liquidity. Liquidity is not just the highs and lows on your chart. Liquidity is the concentration of ordered resting predictable locations, stop losses below obvious lows, breakout entries above equal highs, panic exits at emotional support breaks, retail positioning at every level that looks obvious to the public. This is why price moves the way it moves, not because of patterns, not because of zones, because large participant needs the opposite side of their trade, and retail traders predictably positioned at obvious levels provided. Every SMC concept you have studied is a symptom of this process. Order blocks are the aftermath of displacement, where large participants filled position against retail traders. Fair value gaps are the imbalance left behind when price moved too aggressively for both sides to transact fairly. Break of structure is the evidence that liquidity was collected and a new direction established. The patterns are real, but the patterns are not the cause, they are the footprint of something that already happened. And trading the footprint without understanding what created it is why most SMC traders lose on technically correct setups. Now let me show you what this actually looks like when you stop seeing SMC as a map and start seeing it as a behavioral sequence, because this is the movement where everything you already know start connecting differently. Watch this. Look at this chart. Most traders look at this and see a strong move down, a consolidation, a break lower, and then a reversal. They identify the order block where the reversal began. They mark the fair value gap in the displacement. They note the break of a structure on the way back up. Everything is drawn correctly. Every concept is applied accurately. Now let me show you what is actually happening. The strong move lower is not just a bearish candle. It is institutional displacement. Price moved aggressively to access liquidity, resting below a significant low. The move was engineered, not random. The consolidation is not just price pausing, it is accumulation. Large participants absorbing sell pressure, using retail panic as the counterparty for their long positions. They needed time. They needed orders. They needed the public to keep selling. The break below the low is not a breakdown signal, it is the liquidity event. Stop losing triggered. Breakdown traders entering short. Panic exits, providing the final wave of orders needed to complete the institutional position. Notice the candle did breaks the low, aggressive expansion. Volume spike, but the candle closes back inside the range. Not a close below, a wick, a spike into liquidity, and an immediate return. On the 15-minute chart, structure has not repriced lower. On the 4-hour chart, nothing has changed directionally. The pattern set breakdown, the behavioral set collection, and the reversal that follows is not a pattern reacting to your order block. It is consequence of a liquidity object of being completed. The order block marks where it happens. The fair value gap marks how aggressively it happened. The break of a structure confirms it happened. But none of those drawings caused the move. The liquidity collection caused the move. The drawings are just how we read the evidence afterward. SMC didn't stop working. Your understanding of what it actually is stopped being enough. When you believed SMC was a pattern system, you were asking the market where will price react. When you understand SMC is a liquidity execution model, you start asking what does price needs to collect before it is ready to move from this location. That is not a small shift. It changes every question you ask before an entry. It changes what you look for before a setup forms. It changes what confirmation means and what patience actually requires. Pattern traders wait for the zone. Operators wait for the objective to complete. The chart looks identical to both of them. The question they are asking is completely different, and that question is the edge. So, how does an operator actually use SMC? Not as a checklist, not as a pattern library, not as a prediction system. As a behavioral reading tool, three things the operator looks for that the pattern traders never consider. First, liquidity before the level. Before any SMC concept becomes relevant, the operator identifies where liquidity is resting. Equal highs, session lows, obvious stop clusters. Where is the maximum concentration of incorrectly positioned retail orders? Because that concentration is the objective price is being moved toward. Not your order block, not your fair value gap, the liquidity. The SMC level only becomes significant after the liquidity objective near it has been addressed. Second, cause before consequence. Every SMC pattern is a consequence. The operator looks for the cause. Displacement happened. Why? Liquidity was collected in that move. Whose stop were taken? Whose breakout entries were triggered? Understanding the cause tells you whether the consequence is real or whether price is still building the conditions for the actual move. Third, behavior over appearance. The pattern traders ask, what does this look like? The operator asks, what is this doing? A bearish candle that looks like a breakdown might be a liquidity sweep. A bullish candle that looks like a breakout might be a trap. The appearance is what retail traders react to. The behavior candle, body placement, volume relative to movement, structural acceptance on higher time frames is what operators read. SMC gives you the vocabulary. Liquidity thinking gives you the grammar. Without the grammar, you have words, but not language. Three mistakes that keeps SMC traders stuck. Mistake 1. Adding more confluences instead of deeper understanding. When SMC stops producing consistent results, the instinct is to add more rules, more confluences, more conditions, more filters. But complexity is not depth. Adding 3 more confluences to a system built on pattern recognition still produces pattern recognition results. The solution is not more drawing. It is a fundamentally different question being asked before the entry. Mistake 2. Treating all SMC levels equally. Not every order block carries the same significance. Not every fair value gap will be filled. Not every break of structure signals a new trend. Significance is determined by the liquidity context surrounding the level, not the pattern itself. An order block with untouched liquidity above it, sitting in a premium on the higher time frame against the directional bias is not a trade. It is a drawing on a chart. Mistake 3. Confusing description with prediction. SMC describes what happened. It does not predict what will happen. Market structure describes past price behavior. Liquidity levels describes where order were resting. Order blocks describe where displacement previously occurred. All past tense, all descriptive. The operator uses this description to form a probabilistic read of what is likely, not a certain prediction of what must happen. The moment you treat SMC as predictive, you stop reading the market and start expecting it. Here is your challenge. Go to your chart right now, find the last SMC setup you identified before it triggered or failed. Do not ask, did I draw the level correctly? Ask these three questions instead. Where was the liquidity sitting before price reached my level? And had it been corrected? What was the cause of the displacement that created my level? And whose orders were taken in that move? What price accepting at my level? Or was it only visiting it? One setup, three questions, one sentence each. Because if you apply those three questions to every setup going forward, your relationship with SMC will never be the same. You will stop drawing more and start seeing more. That is the shift. Smart money concepts did not give most traders an edge. It gave them a language. Without teaching them what the language was describing, the patterns are real, the zones are real, the concepts are real, but patterns without context are noise. Zones without liquidity understanding are drawings. Concepts without casual thinking are memorization. The market does not move because you drew the right level. It moves because liquidity had to be collected. Positions had to be built and the conditions for the next move had to be engineered first. Learn to read that process and SMC stop being a system you apply. It becomes a language you think in. Every concept covered in this video, order blocks, fair value gaps, break of structure, liquidity, has a complete dedicated episode in Operator SMC series. That is where the full build happens. The playlist is in the description below. Subscribe. Every episode in the Operator SMC series builds directly on the one before it. This is the full Operator build, completely free.